Hi, I'm Ron Hoppy. Thanks for joining us today. Today I'd like to introduce you to some real estate investments that if you're not already aware of, you're going to really appreciate. But before we get into the meat of the presentation, let me cover the legal requirements first. This presentation is for informational purposes only, does not constitute an offer to sell securities. In order to do so, you must complete an investment questionnaire, and past performance is no guarantee of future performance. With that out of the way, let's get started. I'm going to introduce you to a great investment vehicle that perhaps you're unaware of, that when you become acquainted with it, you're going to love. Trust deed investing. We'd like to share why we believe this could be your best real estate investment opportunity for at least the next 5 years. Explain just how the secondary market works, show you why we're so excited about this opportunity, and discuss what the future holds for this investment. This business was established with a clear mission: to purchase portfolios of non-performing trust deeds, occasionally buying real estate owned by the banks, or commonly known as REOs, and purchase these assets at very, very steep discounts. Now, after the purchase, we're going to share these discounts with the homeowner and offer them creative financial solutions that the big banks are either unable or just unwilling to provide. We're going to strive to keep the homeowner in their home and bring their loans current. Once the loan is reperforming, we're going to sell it to investors on the open market. Now, before I get into the meat of the presentation, I would like to tell you a little bit about myself and why I'd be so bold as to believe I could say anything that you would find important. Well, I've been a business owner and an entrepreneur for nearly 40 years. I've either started or bought, then grew and sold 10 companies, the largest having over 300 employees. And over the years, I've learned a lot about creating management teams and management systems, as well as managing assets, and we're going to utilize those same principles and practices to manage this investment. I've been an active real estate investor since 1985, and I bought my first trust deed in 1991. I've had a real estate broker's license since 1988, and I got a national mortgage loan origination endorsement with the passage of the Dodd-Frank legislation. Now, for those of you not familiar with real estate finance, I'd like to take just a second to define the three main terms that we're going to be using throughout the presentation. The first is promissory note. Now, promissory note is a financial instrument created by a maker promising to pay a determinable amount of money to the lender. Now, when they are written properly, they're known as a negotiable instrument and are very easily sellable on the secondary market. Trust deeds are security for the promissory note that was written. And legal title in a trust deed is transferred to a trustee who holds the property, and the property owner, borrower, gives that trustee certain rights, such as selling the property at auction if the borrower defaults. A mortgage is also a security for a promissory note. It grants the lender, the secured party, certain rights in default. The difference between the two, and we're going to use the terms interchangeably in our presentation, but the difference between the two is that a trust deed is a very short-term foreclosure process. It does not require the lender to take the borrower to court. A mortgage does. In order to foreclose on a mortgage, the lender has to take the borrower to court and sue them to get the property back. Again, we're going to use these terms interchangeably throughout this. There's about 50% of the states in the United States use the trust deed law, and about 50% use the mortgage law. So, with that completed, let's get started. Let's talk about the power of paper, or why notes, why now? You know, we investors have had to look long and hard for any decent kind of returns without assuming a huge amount of risk and without the large volatility swings that we've seen in the recent past. Returns from CDs are simply dismal. This chart shows the current returns from a major bank that they're offering today. Now, almost all of the large banks, or all banks for that matter, are about the same in their rates. And these rates are based upon a minimum deposit of $25,000 and a lockup period. The best rate up here requires a lockup period for 2 years, and for that you get 2%. Now, as investors, we just cannot be satisfied with these kinds of portfolio killing returns. Is the stock market any better? Well, let's take a look. Even with the current run-up, the Dow has returned only 14% over the last decade, and volatility has been frightening, scaring the most savvy investor. Even the recent run-up is suspect in our eyes. It could easily be fueled only by the Fed's printing of money. This increase is simply not supported by any job reports or the economy. Will the run-up continue, or will we see continued volatility and another downturn? Well, there's about an even split between those predicting a bull market and those predicting a bear. And really, with a stock market, what's your security? From 2000 until the recent run-up, over $1 trillion has been lost in the stock market. And if that stock market, or if that company that you own stock in loses money, has a bad year, can you take a part of that back, or can you take the company back? No, you can't. In fact, the security of a stock market is simply a stock certificate. So why do these trust deeds interest us so much? Well, first, they're secured, and they're secured by real estate. They have predictable high returns, and they can provide a stable monthly income. Investment in trust deeds can be an excellent complement to your landlording. And really, it's possible to purchase assets just like the big boys. Now, we purchase on the secondary market, a market that is over $1 trillion in revenue per year. And really, this market is nothing new, because the banks have been doing it since 1938. So why do we want to be like the bank? Well, here's a good reason. Take a look at the skyline of any major city in the United States, or take a look at any major city in the world for that matter, and the most opulent and impressive buildings of any skyline are likely to be banks. Banks or financial institutions who derive the major portion of their profits from real estate finance. It's pretty clear. It's good to be the bank. However, we don't want to be like the traditional bank. The traditional banking industry sees mortgage and trust deed defaults as a huge liability. We see them as a huge asset. And we're going to focus our efforts on finding those high quality return deals in the secondary market. Now, what makes this investment so attractive, and really how did we get to the point that we are today? Well, this graph shows the real estate run-up from 2000 through 2006. Home loans were readily available. Liar loans and loans of 110% of home value were commonplace. Refinancing for cash out and home equity loans were constantly advertised. Many borrowers who were not even qualified to receive loans for automobiles were granted loans to purchase a home, and those loans encumbered the property for over 100% of the house's value. Now, when these homeowners got into trouble, they simply refinanced. That is until 2007. In late 2006 and 2007, the real estate bubble burst. And over the next 5 years, property values plummeted. Some properties losing 50 to 60% of their market value. When that happened, homeowners found themselves defaulting on their payments, but they could no longer refinance. The new stringent lending regulations were instigated and delinquencies rose higher. Now, this caused the foreclosure rate to skyrocket. Bank real estate owned REOs rose rapidly. In addition, the bank's balance sheet deteriorated due to all of these bad loans. The banks had to liquidate these REOs on the market. They're not allowed to own real estate and have to get rid of them within a 5-year period. So they were selling these REOs on the open market. Well, that further depressed the market, and the shadow inventory of homes in foreclosure, but not yet owned by the bank, grew and grew. Lenders realized that to continue to foreclose and sell more of these properties would only further depress the market. In addition, the lenders' own questionable loan and foreclosure practices kept them from foreclosing. Lawsuits ran rampant. Everyone remembers the robo-signing and that big fiasco that stopped foreclosures in their tracks. The number of homes in default continued to rise, and the bubble burst has created what we feel is the greatest real estate investment opportunity in our lifetime. We can purchase these toxic assets at literally pennies on the dollar. 10 cents to 50 cents on the dollar is not uncommon. And after we purchase the asset, our workout specialists work with the homeowner to return the loan to performing status and then sell to an investor, either an individual or an institutional investor. Or we may want to hold that note for cash flow. In most cases, we're going to buy these assets in bulk being anywhere from 10 to 200 loans at one time, and these loans are assembled into what is often referred to in the industry as a tape or a pool. Now, let me kind of give you an idea of just what the market is that we're looking at. There is currently $11.8 trillion of mortgage debt in the United States. And 15% of this debt is delinquent. And banks usually don't even consider a loan delinquent until it's over 60 days past due. So what is this 11.8 trillion with 15% delinquent translate into opportunities for these trust deeds? What's available? Well, last year in one sale, HSBC Bank sold 400,000 loans with unpaid balance of $3.2 billion. FHA also had a one-off sale, $2.2 billion of mortgage sales in one big sell-off. Who buys them? Well, PennyMac, a hedge fund in Southern California, purchased $432 million of non-performing loans in September of 2013. In 1 month, $432 million worth of notes were purchased by one hedge fund. Now, in addition to their own toxic loans that banks had created themselves, the consolidation of the banking industry has had a big influence on acquiring bank to rid themselves of the bad loans that they inherited with the sale. This slide shows the extent of the bank's consolidation due in large measure to bank failures of these banks over here and the larger banks take over. What's obvious is the change in the industry over the last 10 years. 4 large banks on the right, Citi, Chase, B of A, and Wells, are the result of the consolidation of 37 banks showing at the start of the period over here on the left. When the larger banks bought these failing banks, they bought them under an agreement called loss sharing. Now, loss sharing is a process that the banks used to spread the loss of these loans held by these banks that they acquired. In the purchase agreement, the government agreed to share in the loss of these loans, making the acquiring bank more willing to sell them at steep discounts. So why are the hedge funds purchasing these assets? Simple. They recognize the huge potential available. Now, the banks must rid their balance sheet of these toxic loans. Every bad loan erodes the amount a bank can loan because of the reserves that they must keep. They typically sell these notes to major hedge funds in lots of from 50 million up. And that's where our opportunity lies. The huge hedge funds assemble smaller pools. They pull them out of the big pools that they bought, and we buy those smaller pools from them. Our methodology for this business is to purchase from these hedge funds, decide at the purchase really what our exit strategy should look like. That is, how we can profit from the transaction, work out the loan, and sell to an investor or hold for cash flow. Our effort is directed, number one, at keeping the homeowner in their homes. And since we now are essentially the bank, we own the loan, we became the lender, we can decide to do whatever we like to do with that loan. We can do things the original lender, again, cannot or will not do. Now, here's a list of the primary exit strategies that we look at when we purchase a loan. We can sell it immediately. That is, sell it to another investor who wants to do the workouts themselves. We can offer a discounted payoff to the homeowner. Because we bought at such a steep discount, we can share it with them. We can work this loan out and sell it. Our workout specialist will work a payment plan, collect a portion of the arrears possibly, and after the homeowner's established a pay history, sell the note to an investor. We can also work out and keep it for cash flow. After the workout, a payment plan agreed to by the homeowner, the loan can be kept. Short sale. Sometimes the homeowner simply can't afford the house. In that case, we may get them to agree to do a short sale where we will handle the process, hiring the real estate agent, negotiating with the bank, and so on. A deed in lieu. In this case, a deed in lieu of foreclosure, we may convince the homeowner that the best solution is for them to just sign over the deed and avoid the foreclosure process. We probably offer them some money to accept this transaction. And then, of course, there's a foreclosure. In some cases, there's just no way to save the house. It may be vacant. the homeowner may have reached the point of no return. They just want to be done with this and they don't even want to talk about it. So let me show you some examples of recent transactions to shed some light on some of these investments and exit strategies. First, let's talk about the immediate sale of the note that we just purchased. In this case, fair market value of the home was $115,000. There was a first mortgage on it of $140,000, a second of $42,000, and we bought the second, which had an unpaid balance of $39,750. We purchased it for $3,975, or we purchased it for 10 cents on the dollar. We immediately sold this note to an investor on our list for 13 cents. And we netted $1,192, a cash-on-cash return of 30%. And that was within a month we would sell that. We call that immediate sale. A discounted payoff, this property had a fair market value of $170,000. The first trust deed was $168,000, the second $50,000, and the second had an unpaid balance of $43,509. We purchased that second for $16,000. Our workout specialist worked with the homeowner, and the homeowner agreed that they would pay $25,000 as a discounted payoff for that $43,000 note. Our expenses on this note were $2,340. We netted $6,600, or a cash-on-cash return of 41.6%. Workout and sell. Now, workout and sell is our primary focus. This is what we do the most of. In this case, we bought a loan with a home value, fair market value of $150,000, a first trust deed of $128,000, and a second for $56,000. Now, one thing that you'll notice in all of the transactions that we've done, all of these homes have been upside down. There's owed more than the home is worth. This one had an unpaid balance of $53,500, and we purchased that second for $11,700. We collected $3,000 in arrearages from the homeowner. We had $1,800 of expenses in operating that loan while we had it. We also received 7 payments of $375, which is what the homeowner agreed to pay from that time forward. We sold that for $16,875, and we had $400 expenses on selling that note for a net cash return of $8,600, or a cash-on-cash of 74%. How about a workout and a hold? In this case, the fair market value of the home was $268,000, had a first of $285,000. The house is underwater on the first alone. The second had an $81,000 note written, and the unpaid balance was $76,400. We purchased this second for $12,225. We had $1,600 in expenses in administering the workout. We worked out a payment schedule with that homeowner for $500 a month. That's an annualized return of 49.1% on a loan that we kept. Now, that's a great return. However, it's even better if you were to consider it in your IRA or in your Roth IRA. That 49% return could be tax deferred or tax-free. Wonderful investment opportunity. Sometimes the homeowner's not going to stay in the home. Here's a case where the homeowner left. Homeowner agreed to do a short sale. We got the house sold for him. House had a fair market value of $195,000. There was a first of $235,000 and a second for $55,000. The unpaid balance of the second was $52,500. And we purchased that $52,500 note for $6,100. We assisted the homeowner to do a short sale. Short sale came through. The first agreed to let us take $5,500 of that sale. And so we had the first allowed us to get $11,600 payoff from the sale. So we netted $5,500 on our note with a cash-on-cash return of 62.3%. And the lender of the first paid all the expenses and sales costs on this deal. And then there's the deed in lieu of foreclosure. The fair market value of this house, $123,000. The first, $200,000. Unpaid balance, you see there, we purchased that for, this happened to be a purchase of a first mortgage, and we purchased that for $56,250. We paid the homeowner $3,000 in moving assistance and to help him relocate. And we immediately sold that property to an investor who had been identified by a realtor in that area before we ever purchased the note. We had sales expenses, real estate commissions, and so on of $7,710, and we netted $17,540, or a cash-on-cash return of 31.2%, and that was in 120 days. And the last, and the one that we hate doing the most, but sometimes we're just forced to do it, in cases where the home is vacant, we can't even find the homeowner, or the homeowner is just done with it and doesn't want to talk about it anymore. In this case, the fair market value of the house was $155,000. The second was $286,000, had an unpaid balance of $274,000, and we purchased that first for $62,000. Expenses like legal and so on to foreclose was $3,825. Our sales expenses were $10,650, and we netted $36,025 on this, or a cash-on-cash return of 58.1%. So these returns do look attractive, but it's interesting. The most common question we get is, yeah, they look good now, but what's the future hold for this business? That's the most often question we receive. How long is the opportunity going to last? Well, we don't have a crystal ball, and I hate to make predictions, but we can make some projections based upon facts that we know that are very clear. And here are some facts. This slide shows a snapshot of the distressed real estate market. Notice the small black box at the far right of the slide. This box represents the residential real estate owned by all banks today. This is the total currently owned. Everything owned by the banks today. Now, everything to the left of this black bar represents the late and the non-performing notes working their way toward the black bar. History shows that very, very little of this massive amount will be worked out by the banks, and most of it will be bought by investors such as us. Now, it's obvious. A large amount headed toward REO. Currently, there's 28 times, 28 times the late and non-performing notes as there are the REOs already owned by the lenders. And residential is just the tip of the iceberg. Again, looking at the same graph but for commercial, we see that the commercial REO is represented by this light blue bar at the far right. Again, everything to the left of that bright light blue bar represents the current non-performing notes. Non-performing, keep that in mind, non-performing notes, ones that are not paying, headed for foreclosure. The amount headed down the path to REO is 5 times the amount the banks now own. So commercial is only 5 times. However, this doesn't even tell the true story. Most commercial loans are written with very short maturity times. Even though they may have long amortization periods to lower the payment, let's say amortization periods of 20 to 25 to 30 years, most commonly they are short maturity and the note comes due in 5 to 7 years. That is, they must be paid off or refinanced in 5 to 7 years. Now, during the last 5 to 7 years, these commercial properties have lost a great deal of their value also. Real estate experts agree that at least 2/3, that's 2/3 of all the loans maturing in 2015 to 2017 cannot be refinanced and therefore will enter the distressed loan market. And the lenders are going to be looking to investors like us to buy these notes at steep discounts. Now, these are non-paying. They're defaulted notes. The ones that are coming due could very well be performing, but that doesn't matter. They still have to be refinanced, and they can't be. So they're going to enter the distressed market. There's over the $1 trillion of commercial real estate loans coming due between 2015 and 2017 that cannot be refinanced. Everything to the left of this bar is going to be increased. So we know that the market is going to be here for quite some time. We also know that the market can be quite profitable if you know what you're doing. So just what are the keys to the success of this business? Well, first, relationships. Relationships with both hedge funds and the vendors that we do business with. It's taken us years to develop relationships with the hedge funds and with the regional lenders that we buy from. They know that if we say we're going to close, we close. They know that we are quick and that we know what we're doing. In addition, due diligence, the ability to do due diligence quickly and to do it competently is extremely important. Due diligence is what tells us the price to pay and how to go about working it out. Bulk purchasing is important. We buy in large numbers from banks. We buy hundreds of loans per month, and by doing so we can spread our pricing, that our blended rate, the rate we pay for the entire pool, is lower than if we were buying in small volume. Because of the time we've been in business, we've been able to create proprietary software that helps us manage the business. We have a sophisticated training program to train workout specialists to befriend the homeowner so that they become the homeowner's friends and truly have the reputation of wanting to help. We have, because we buy in bulk and we've been doing it for a while, a very diverse portfolio. Diversity of portfolio is extremely important. We're diverse both geographically, we buy on a national basis. Price-wise, we buy some low-cost loans, some high-priced loans. We buy firsts and seconds. We diversify the portfolio. That becomes important. Somebody with $100,000 to invest, for example, would buy maybe one loan. Well, if that were the case, where do you think the epicenter of the next earthquake would be? It would probably be right where that house was located. And then we have excellent underwriting capabilities. So it's quite evident that with the proper knowledge, the right tools, and experience. Returns can be quite impressive on these distressed trust deeds. If you're interested in learning more, if you'd like more information on this investment vehicle, please call me. My number is on the screen. I'd love to talk to you about the note business and the opportunities that do exist in it. Please feel free to give me a call. Thank you.